Hello everyone. In this video I'm going to continue my discussion for Chapter 4 and we're going to focus on the accounting cycle. So what is the accounting cycle? So as I said in the very beginning of the discussion of this chapter is that in this chapter we are actually going to finalize everything that accountants do. And what accountants do is typically starting with recording transactions and then journalizing the transactions, posting to ledger, do the adjustments, and all the way until we close the journal entries and prepare the adjusted or the post-closing trial balance. So this is basically the accounting cycle. So the accounting cycle is the process that begins with analyzing and journalizing transaction and ends with the post-closing trial balance. So it has few steps that we have to be aware of. I don't want you to memorize them, even though I think it's easy to remember them if you understand how the accounting process works. But I really want you to know the order of them. Like I want you to know which step happens before which other step. So what are these steps? This first step is transactions are analyzed and recorded in the journal. And then once this happens, we post to the ledger, and that's step number 2. In step number 3, we prepare the unadjusted trial balance. And then in step number 4, an adjustment data are assembled and analyzed. Step number 5, which is optional, by the way, we didn't cover it in this course, even though we just discussed it briefly at the beginning of this chapter, which is an optional end of period spreadsheet is prepared. So basically like an Excel sheet can be prepared. Then starting step number 6, this is where it gets to be important, where we have the adjusting entries are journalized and posted to the ledger. Step number 7, an adjusted trial balance is prepared. And then step number 8, we prepare the financial statements. And I hope you still remember the order of the financial statements. We start with the income statement. Then we have the retained earnings statement or statement of retained earnings. And then we have the balance sheet. Once these are prepared, we close the books by closing entries where we journalize them and post them to the ledger. And then the last step is to prepare the post-closing trial balance. So basically this is what we do during the accounting cycle. And why we call it a cycle, even though it's just steps, because once you end by step number 10, you start over again in the next period with step number 1. So let's see like a diagram that shows these steps. So again, in chapter 1, we got to know the accounting equation, and we talked about the accounting system. And this is where we have the first step, where transactions are analyzed and recorded in the journal. In chapter number 2, we got to the rules of debit and credit. We've seen how the accounting equation is related to the balance sheet, and we've seen the income statement and the statement of retained earnings. And this is where we have the second step, where transactions are posted to the ledger. And then in step number 3, where we have the unadjusted trial balance is prepared. And these are the 2 steps that we have done in chapter 2. In chapter 3, this is where we had the adjusting entry, so you can see that adjustments data are assembled and analyzed. And then we had this optional end of period spreadsheet or Excel sheet, which we didn't prepare. It's available in the book, I believe in the appendix, but we didn't go over that. And then we went over step number 6, where we have the adjusting entries, where they are journalized and posted to the ledger. And then in step number 7, we prepared the adjusted trial balance. And then in chapter number 4, we had the financial statements are prepared, and we've seen how we prepare the financial statements using the spreadsheet. And then in step number 9, we did the closing entries. So they were journalized and posted to the ledger. And step number 10, the post-closing trial balance is prepared. So basically, this is what we've done over the first 4 chapters. And you can see, as I told you before, the first 4 chapters are considered to be the foundation of accounting. So I really want to encourage you to be very well prepared for the coming exam by understanding these 4 chapters, because they represent the foundation of accounting. Everything that we're going to be covered later on is just an application of what we learned in the first 4 chapters. So again, the first 4 chapters are considered to be the foundation of what we're going to be learning in the future. They're very interconnected, so make sure that you spend enough time to understand all the details of these 4 chapters. So now let's briefly have like a quick illustration of the accounting cycle. So this is basically where we're going to be seeing which is a full set of records and documents that are going to be prepared in the accounting cycle. But here we're using a different company, which is called Kelly Consulting. So the following slide will provide an illustration of the accounting cycle for Kelly Consulting. I'm going to be going over them very quickly because this is basically repeating what we've done in the previous chapters. So we have the chart of accounts, we have the journal entries, unadjusted trial balance, end of period spreadsheet, adjusting entries, adjusted trial balance, the financial statements, closing entries, post-closing trial balance, and then finally we'll see how the ledger looks like. So this is the chart of accounts for Kelly Consulting, and you can see that we have the codes on the very left and then the name of the accounts. One thing that I want to make clear for you is that this company, they use the code 1 to represent for assets, the code 2 to represent for liabilities, 3 for equity, and you can see here we have return earnings and dividends, and the income summary, and then 4 for revenues and 5 for expenses. This is not part of GAAP or not part of generally accepted accounting principles, but every company can use whatever they feel is the appropriate kind of coding depending on the size of the firm and the number of accounts they're using. Again, you can see in companies using something similar to that, which I think this is a little bit limited, but it can go over like 3-digit numbers, 4-digit, sometimes 5 digits, depending on the kind of accounts they have. The next document is the journal, and you can see here that they have several journal entries recorded, and you can see that most of these journal entries are one on the debit and the other in the credit. In some cases, we see, like in this example where the company started, we have common stock on the credit side and cash, accounts receivable, supplies, and office equipment were on the debit side. These are all the transactions that took place in April 2018. You can see the continuation in the next slide, and some more on the third slide. So these are all the transactions that took place during the month of April. One thing I want to make sure that you're clear about is how we record the journal entry is that we record the date, we debit the account first, and then we credit the other account, and we put the values. And whenever we post them, we report the post reference column, the number of the code of the account that it's been posted to. Then we have here the unadjusted trial balance, and these are based on the ledger, even though the ledger is the last thing that we're going to be presenting in these slides. But here we have all the list of all the accounts that we have in the business, starting with cash, because cash is the first asset that we usually like to have, all the way to the last kind of expense, which is typically miscellaneous expenses. And then they should have their debit and credit balance. Each account should only have either a debit or credit. And then the total values at the bottom for the debit and credit should match. And that's the purpose of the trial balance. That's the first type of trial balance. Remember, we usually prepare 3 types of trial balances. We have the unadjusted, we have the adjusted, and we have the post-closing trial balance. So here is also an example for the spreadsheet that we use in order to update our adjusting entries. So you see here the unadjusted trial balance, we have the adjustments, and then we have the adjusted trial balance. And usually we use the adjusted trial balance here to prepare the financial statements. So before we go to the financial statements, let's see how the adjusting entries look like. So these are the list of adjusting entries that they have for the month of April. One thing I want you to remember, the 3 conditions. It's end of the period, so all of them are April 30th. No cash is involved, so we don't have any cash in any of these adjusting entries. And then for every adjusting entry, it's one income statement account, so like this, insurance expense, and prepaid insurance, which is an asset, which is a balance sheet account. So one income statement, one balance sheet account. If you go over every one of these, they should be the exact same value as I just mentioned. Then we have the adjusted trial balance, and this is the trial balance that we prepare once we record our adjusting entries. So you expect this to be more updated because this is the one that's going to be used to prepare the financial statements. And again, so how the financial statements would look like, you always start with the income statement where we list our revenue, deduct all the expenses, and the difference is net income if it's positive. If it's negative, we call it a net loss. So one thing I want you to pay attention to, these are not debit and credit. You can see here, this is just a sub-column where we have all the values for the expenses, and we have the total to get to be deducted from the revenues. Then we have the retained earnings statement, or what I like to call a statement of retained earnings, and it's basically consists of four lines where we have the beginning balance, we have the net income, we have the dividends, and then the ending balance of retained earnings. Usually we add this line called change in retained earnings to combine these two together. Okay, so 18,300 minus 6,000 is 12,300. Again, remember, this is a startup company, so it's just started, so they don't have a beginning balance. So we add the change in retained earnings, and that would give us the ending balance of retained earnings. And that would be used in the balance sheet. So the next statement would be the balance sheet. And the balance sheet is divided into asset side, liabilities, and equity side. So the assets total should match the liabilities and stockholders' equity total. So you see here the assets are divided into current assets and property, plant, and equipment, where we have the total for the current assets and the total for the property, plant, and equipment. We add them together, we get the total assets. Then for the liabilities, we have the total liabilities here, and we only have current liabilities in this example. And then for stockholders' equity, we have the common stock, we have the retained earnings, and these together would give us what we call the total stockholders' equity. We combine them with the total liabilities to get the total liabilities and stockholders' equity. The retained earnings balance, the 42,300, if I go to the previous slide, that should be the value here. So I think I missed the number. It's the 12,300, the retained earnings balance, is the ending balance that we have here for the statement of retained earnings. So make sure that this value is the value that we move forward to the balance sheet, and it would appear under retained earnings 12,300. So once we're done with that, the next step is to just close the temporary accounts. And we have 4 closing entries. We close the revenues, we close the expenses, we close the income summary, and then we close the dividends. Okay, so basically we close our fees earned, which is our revenue, we close all the expenses, and then we close the income summary account based on the difference between these two values, which is the 18,300, and then finally we close the dividends balance. Once we're done with that, the last thing is to prepare the post-closing trial balance. So in the post-closing trial balance, we expect to see only the real nominal account. The temporary accounts would disappear. In other words, we won't see revenues, expenses, or dividends, because all of these would have zero balance. So we only see assets, liabilities, and equity. And again, the totals of debit and credit should match. The last thing I want to share with you is the ledger and how it looks like. And again, we have like separate account for each account that we have. All the real accounts would always have a balance at the very end. The temporary accounts, like the revenues, expenses, and dividends, and the income summary, they will all have a zero balance at the very end. So you can see here that all the expense accounts, they have a zero balance now. Okay, so that finalizes our discussion of the accounting cycle in a very brief discussion. Now let's talk about something called the fiscal year. And the fiscal year is basically the fiscal period of the business, and it's just it could be the calendar year if it starts and ends on January and ends in December. But if some businesses, they like to start on, let's say, July 1st, they can do that. So the fiscal year would not be like the calendar year. So the annual accounting period adopted by a business, we call it the fiscal year. And the fiscal year begins with the first day of the month selected and end on the last day of the following 12 months. I have to admit that there are a few exceptions for this rule. We see companies like Apple, sometimes they select a day in the middle of the month to be their beginning day, and usually that's the day where they release their new product. So when a corporation adopts a fiscal year that ends when business activities have reached the lowest point in its annual operating cycle, such as fiscal year, is called the natural business year. And this is what many businesses do. So businesses like Walmart, for example, that's what they do. They wait until things slow down, and that would be the end of their accounting period. And then they start a new period when it peaks up again. So, for example, Walmart, they start their accounting cycle or their fiscal year in January, February 1st or January 31st. So February 1st, and this is like after the Christmas season is over and they get all the product returns and everything is done, then they start when things are fresh again. So financial history of a business, you can see here that companies, let's assume that they're using the fiscal year as a calendar year. So we have here a company where they have 2016, 17, and 18. The income statement would show the performance of the business during a year. Okay, and I always say this is very similar to like a video cam. But on December 31st, this is where we have the balance sheet prepared. So you can see that balance sheets are prepared on one day, or they cover one day, but the income statements, they cover a period. So each one of these periods would show the performance of the business, and we show the balance sheet, which is the assets, liabilities, and the equity of the business, on the last day of the period. Last thing that we're going to have in this chapter is some kind of analysis for decision making, and we're going to learn two new concepts, something called the working capital and the current ratio. And I really want you to learn these because, again, as I always say, if there's something I want you to learn out of this class, is the ability to use the financial statements to make decisions. And the working capital, the current ratio, are some kind of measures that can help you make decisions related to liquidity and solvency of the business. So the ability to convert assets into cash is called the liquidity. And the ability of a business to pay its debt is called solvency. These are two financial measures for evaluating a business: short-term liquidity and solvency, and we use what we call them the working capital and the current ratio. So let's see how they're calculated. And we'll start with the working capital. So the working capital is the excess of the current assets of a business over its current liabilities. So in simple words, if we put in the model, working capital is the current assets minus the current liabilities. If we have a positive working capital, this is good news. It implies that the business is able to pay its current liabilities and it's solvent. So all businesses should make sure that they maintain a positive working capital. If you have a zero working capital, I would say you're just covering your current liabilities, but it's not the best situation. It's always good to have a positive working capital. What if we have a negative current working capital? Then this is dangerous because you don't have enough current assets to satisfy your short-term or your current liabilities. So let's see an example here for net solutions. The working capital is calculated as current assets minus current liabilities, and their current assets was $77.45. The current liabilities $13.90. So that gives us a positive $6,355. So as you see, this is a positive number. Again, the problem with this is that it doesn't tell you, is this good or bad? Because $6,000 might be, for me, it's a big number, but for maybe large companies, this is close to zero. So this is why working capital by itself doesn't tell much. This is why, in this case, we'll have to use the current ratio. So the current ratio is another form of the working capital, but instead of subtracting or getting the difference between current assets and current liabilities, we actually divide current assets by the current liabilities. So the current ratio is another means of expressing the relationship between current assets and current liabilities. So the current ratio is computed by dividing current assets by current liabilities, and you can see the simple formula for that. This is one of those formulas that I really want you to know. I think for all other formulas, maybe you can go back to the book. But for anyone who took an accounting class, I think this is very important for you to keep in mind. This is really, really important. So how we calculate it? Again, let's see here for net solutions. We divide current assets, which is $77.45, by current liabilities, $13.90, and that gives us 5.6. So this means that for every dollar of current liabilities, the company has $5.60 in current assets available to pay these current liabilities. I think this is very good. So it just shows that the company has available current assets that can pay its current liabilities comfortably. So by that, I'll conclude this chapter. I'll see you next week. Please study hard. We have an exam next week. So let me know if you have any questions.